If you're a Canadian and you want to know how to invest in US real estate the right way without overpaying in taxes or overcomplicating your life, this is the video for you. I have my friends here from Sal Accounting. They are very knowledgeable about how this works. They're explaining everything to me. I'm going to try and get the citations and the references for you at the end of the video. But without further ado, Sal and Alex, thank you for being here, guys. Tell me, what's the most common way that you see or you advise your clients to buy real estate? Let's say someone's buying, two examples, someone's buying a single family house or someone's buying a multifamily, like 40 apartments. Like, how are you telling these guys to do it?
Yeah. Yeah. The most simplest way is just to get in their personal name, right? Now, if you wanna just keep yourself free from liability, you can just do an LLC, right? Now, and let's get into that, the double taxation and all of that later. Coming to your second part, which is if you're getting 40 apartments or 40 units or something like that, we definitely recommend going for an LPGP structure. We do have a diagram on that. Are we able to share screens?
Yeah, you can share your
Sure.
screen for sure.
Yeah, let's get into that.
I'd love to see your diagram on that. And then
Yeah,
explain how
sure.
you do the US tax compliance part of it, because that's where I've seen some crazy structures. I've seen foreign trusts, Canadian corps, and we're using treaties and we're doing LPs and we're doing all this crazy stuff. Oh, this is
So,
way easier. This is great. Okay.
so here's the border of Canada and US, right? So you have a Canadian individual who wants to buy, let's just say 3 properties here for simplicity's sake, right? You would have a limited partnership in the United States. You would have 99% limited partner as the Canadian individual, one or many, however you want to structure that. And you would have 1% general partner, and that general partner as it could be an LLC, and it's owned by the same person. Now, the reason we do an LP is because that is the one of the few structures that is congruent between Canada and US and how it's recognized. So an LP is recognized as a partnership in Canada and obviously in the United States as well. The reason we're keeping majority of the ownership here and just a little bit here is because of the whole double taxation and how Canada sees an LLC as a corporation, whilst in the United States it's a pass-through entity.
Well, an
So you
LP, I'm sorry to interrupt you. It's just an LP needs to have two partners. That's why you make a 1% partner.
well,
You just need to
yeah,
have
but
two
also
people.
yeah, but also the fact that you have what you call it only 1% ownership here, because the
Yeah.
profit is it's 1% going through it's 1% profit going through the LLC. So there's not really any double tax risk here for
Yeah.
1% of profit, right? So that's why you flow only a percentage through here, and majority of your income's coming straight on to the individual themselves, right? Here you're just going to have your regular 1065 form text 65 filed, issued K1, and just going to report it in your Canadian personal tax return as the owner. So scrolling down, you have the same structure, right? The only thing is that you have LLCs in the middle just
Yeah, I like
for
this better.
liability
This is what I
protection.
was going to recommend. I was going to recommend this.
Exactly, exactly. This obviously just adds that extra layer of protection for the client, and making sure that any sort of litigation against property A doesn't come onto property B or C or what have you.
I'm going to interject real quick. In this diagram A and B, all that we're filing in the US is a form 1065 for the limited partnership and then a form 1040NR for the Canadian individual. The taxes would be paid on the Canadian individual level, and you get a credit in Canada for whatever taxes are paid in the US.
Exactly, exactly.
And the LP is passed through, like we talked about the LLC being treated as a corp. It's a mess between the US and Canada. So that's why people use the LPs. So you have a more complicated one. Let's get to that, because this is so straightforward. I don't know why I don't see more of these, but I like this a lot. It's
Yeah,
it's very,
yeah.
very usable.
So there, Alex, you could correct me on this, but given the fact that if you got real estate in the United States, it is going to be taxed first in the USA, right?
Yes, it's right.
It's tax, yeah, yeah. USA has the right to tax first because the real estate's
Exactly,
here.
exactly. Yeah, yeah, exactly, exactly. Yeah, so this is a very similar structure. Just the fact that just to lower your tax rate, if somebody's already in a higher tax bracket, you have a Canadian corporation in the middle, which is basically making sure that you're paying 12.5%, taking Ontario as an example. You're paying 12.5% instead of whatever 30, 40, 50% that you might have. Again, you could have below that, you could have without LLC or with LLC.
The problem with this structure that I've seen is that the filing in 1120F is a lot more complicated from the U.S. side, and then also there's the branch profit tax that applies whether when you're sending more than $500,000 of profits back. So for a simple investment, it greatly complicates how it's done. Who would you recommend Diagram C for? People that have a pay a ton of taxes?
Yeah, basically,
Okay, so if
because
you're paying more
they already.
taxes, it's potentially a lower tax in Canada thing. Okay.
Also, what I would again remind folks is that this is, you're only paying 12.5% if your total net income from all your other corporations and this one obviously is less than 500K per annum. If you're crossing that, then you're already in a high tax bracket, even on the corporation level.
Oh,
Deduction
so
for,
it's actually for less income people. Interesting.
well, folks that are less, that's a subjective term, right? So if you're under 500K across all your companies in net profit, you get the small business deduction as a Canadian controlled private corporation, which only levies 12.5% tax rate as opposed to 28%.
Let's go to diagram D. This is my favorite.
Yeah, diagram D is just having a US C Corp and owned by a Canadian corporation, or could be an individual as well. The only problem here is that you're paying 21% tax rate. The other problem is the dividend the C Corp pays out to the Canadian corporation. Alex, do you want to jump in on this part and how much is withheld here and what the foreign tax credit
So,
that you get?
well, from the U.S. side, when sending a dividend out of the U.S. corp, there is, I think it's 5%. We can take a treaty rate. Maybe it's
Exactly.
10%, but I think it's 5% treaty rate. But what most clients do is they'll do a return of capital, or they'll do a loan, or they'll pay for services, or they'll do something else, because getting a foreign dividend generally is not the best. And if you want to get all your money back, you basically liquidate all the assets and liquidate the C corp, and then you bring it all back. I think it's capital gains, which aren't generally the best in Canada, but I think it's the same tax you pay otherwise. I don't. Maybe it's not. Maybe I'm wrong. A lot of people keep the C corp and keep the money in it and keep reinvesting.
Yeah, so basically that's when you want to reinvest that money in the US market to buy some more multifamily homes. So you always keep that money in the C Corp and reinvest in the US real estate. And you're right that you can, rather than paying dividends to a Canadian corporation, like the person in Canada can charge a management fee or consulting fee to the US business and take out the money and report it in the personal income tax return in Canada. Also, he will get the credits in the US tax return. Like obviously the consulting fee he can deduct from the expenses of the C corp.
Yes, and it's deductible, so you're not paying double taxes there.
Exactly.
So Um, yeah, I think when we look at the pros here, I love your chart. This is a great chart. So the
Thank you.
pros is liability protection. I would always lean with option two here, where you have with the LLC. So when you have basically like Wyoming C corp or LLC taxes C corp, whatever, and then you have LLC property, LLC property, LLC property. You have every property under its own LLC. It doesn't have to file its own tax return per se, especially if it's under a reporting company, but it does give you additional legal liability and anonymity, and it costs an extra $100 and $200 a year or something. So,
Yeah.
um, yeah, I think I generally push people towards this just because of the speed and simplicity of setting it up, the additional legal protection. The LP is not a bad option either. I like the option one. Option two is okay. I generally avoiding option three, and option four is probably my favorite. But I try and give the best recommendation to the client based on what they're looking for.
Question for you on the management fee. Usually we when we do these returns, we are a bit more cautious and we only take management fee max up until half of the net profit of the company. Do you literally just take everything out as management fees? Is that acceptable audit wise, IRS audit wise?
In terms of transfer pricing agreements, it's what the market deems is reasonable for that service on the open market. If it's a huge amount, if we're talking about 500 properties, then we would get a transfer pricing study and we get a formal opinion on how much the management fee should be. If a guy
Right.
has 5 properties and he made 50 grand and he wants to send 30 grand back, like it's pretty low risk. Like it's not that big of a deal. So
Got it.
um, it's advice based on the scope and the scale of where we're at and like the exposure. But yeah, if there's like 400 properties and it's a huge portfolio, then yeah, you got to get a study and seeing what is it worth to manage all of these. And if you have 8 other property managers, how much are you paying them?
Yeah,
So, um, but also at that point, you probably don't need money as much, you know, because you probably have like you know, it depends. So,
yeah,
that's how we do it. That's how I would recommend it or advise on it. I try to
perfect.
avoid dividends, generally, because just like I don't like to file the 1042s. It's like a double tax thing. Getting foreign dividends in Canada is like ordinary income over there. So
Yeah,
there's not really much of a benefit to do a dividend. Like it's way
yeah,
better to do an actual, because a dividend in Canada is taxed the same as our other income, right?
yep, yep,
Yeah, so we might as well deduct it in the U.S. side. A dividend isn't deducted, so that's why we always do it that way and stretch it
yeah,
out as much as we can.
yeah, 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 makes sense.
What's the most common structure you guys see? Is it the first one where people have an LP? Is that what you guys set up the most?
Usually, yeah,
It's pretty simple, right?
yeah,
Where are you
yeah,
setting up the
exactly.
LPs? In what state?
LPs, it just depends. Usually it's Wyoming. Just makes it simple because that's where we usually make the LLC as well, the GP, right? And then the LLC below that is just based on where the property is.
What are other common challenges that your clients are facing when investing in the U.S.? Like, what are the biggest problems that your clients are having?
I think cross-border banking is one. Folks sometimes ask where should we bank with, how to get money across, and even FX rates, right? What we usually tell them is, well, Wise and Remitly are two uh, sort of foreign exchange, like money transfer companies that are usually cheaper than their banks. But if you have to go with a bank, because sometimes folks have like hundreds of thousands of dollars for the down payment, then we usually recommend going with TD Bank because, as you know, TD Bank has a lot of branches in the United States, in most states at least. So it's just easier that way to have cross-border banking. But otherwise,
So
there's CIBC and all of that.
it's interesting because TD Bank, I thought was bought. It got merged with Charles Schwab. It was a Canadian bank, but it got kind of swallowed up by the U.S. bank Charles Schwab. I'm still interested. How they're really hard to open accounts in the U.S. Like if a foreign person comes to a TD Bank in the U.S., it's not easy. But I guess it would
Interesting.
work potentially. I have a lot of people use RIBC, and they have like U.S. accounts. I mean,
RBC, yeah,
That's what I talk about all the time on my videos.
exactly. TD is pretty easy to open from Canada through a cross-border bank, but I think that's the case with most banks anyway. So RBC, CIBC, or any of them really.
Yeah, I mean, it's sending money is not hard. I have some clients who struggle with bank accounts, and that's what I talk about. And that's why I was going to segue into a self promotion video sponsored by James Baker and Associates. If you if you're interested, if you have a want to invest in the U.S. and you're Canadian, I definitely recommend you guys schedule with and talk to Canadian tax advisors. Sal Accounting, these guys really explained and shared their expertise and their ability to be flexible with the interpretations of how it benefits their clients. And if you want to get accounts open in the U.S., companies in the U.S., get your taxes done in the U.S., that's what I'm doing all day. That's what I'm talking about. And if you like this kind of stuff, this content, like and subscribe.